Thank you so much for taking the time to sit with us today and speak with us on Mine Stock Talk. To get started, we would just really like to get a brief overview of your role and background in the industry. And royalty companies are vastly different than most mining companies. A lot of investors, and I'm just learning a lot about this myself, they don't really understand the difference between them. So if you could just provide some insight on that, that would be amazing.
Well, I can start with my background. So currently, I'm chairman and CEO of Gold Royalty Corp. I have been since August of 2020, so coming on 4 years. So joined prior to the IPO, formed the company really from scratch with my co-founder and partner, Amir Adnani, who runs a uranium business, but had a gold business on the side that we've used as the basis to create Gold Royalty Corp. Took it public in March of 2021. Before that, I spent well over 30 years on the operating and development side of the business with a variety of companies. I was the former CEO of Gold Corp until it merged with Newmont in 2019 to create the world's biggest gold company. I ran Hudbay Minerals on the copper side for about 6 years. I spent 12 years as CFO of Agnico Eagle, which is currently the third biggest gold producer in the world by market cap and production, and spent 8 years before that with Inmet Mining on the copper side. Spent equal amounts of my career both on base and precious metals. And over the course of my career, I've been involved in the construction of 15 mines, both on the base and precious side, and across a variety of jurisdictions, largely within the Americas, but also in Australia and Europe as well, and North Africa for that matter. So brought a development and operating pedigree to what's traditionally been a financial services business. Royalty companies are generally run by financial engineers, but not by people that have actually operated and built mines. But if you look across our boardroom table and in the C-suite, it's populated by people that have actually developed and operated mines. And that's by design, because I think having that kind of background provides two distinct advantages. One is we can properly assess the risk inherent in what we're investing in and taking royalties back, so we can price it appropriately, make sure we get an adequate rate of return given the inherent risk. But also with 400 years of collective experience within my board of management, we have access to everybody in the industry, from the most senior companies to the most junior. And that affords us a very robust pipeline of opportunities to grow our business. That's why we've gone from 18 royalties in our IPO to over 240 royalties today. That's a tremendous growth trajectory in 3 years in any business. And that's because we can access opportunities much more readily and before many of our competitors are even aware of them. And we've, as a result, been able to grow very, very quickly.
A question then based on that, and for our viewers who are, some of them are quite a bit younger, and we're trying to point out that royalty companies are a great option. So for Gold Royalty, where would you say your primary properties are, or those that are, say, the least risky?
Yeah, so 80% of our royalties by number and also by value are in 3 jurisdictions: Nevada, Quebec, and Ontario. And I would say that's also by design. They are perennially rated among the top 5 jurisdictions in the world by the Fraser Institute here in Canada for mineral potential, low political risk, and low regulatory risk. And that's extremely important in the royalty business because at the end of the day, we don't actually own any physical assets. We have contracts. Those contracts give us royalties on the properties. And so we have to ensure that we're in jurisdictions that respect the sanctity of those contracts, have a legal framework and jurisprudence to ensure those contracts are protected, and they run with the land. And so that's an extremely important element of our business. So we can't be in just any jurisdiction, because if those royalty contracts are not respected, if there isn't a rule of law, then our ability to collect on those royalties is compromised. So it's extremely important to focus on jurisdictional risk when you're investing in a royalty and streaming company.
So follow to that would be, just as an example, what would be one of the deals you have with, say, one of the big players that you would call a given cash flow, especially if gold keeps moving the way it's been?
Oh, that's an excellent point. And, we're not just about optionality and just throwing as many royalties against the wall to see what sticks. We do have a lot of optionality in the portfolio with over 240 royalties, but Within that royalty portfolio, we actually have royalties on 3 of the 5 biggest producing gold mines in North America. So we have a royalty in Canadian Malartic, which is probably around number 2 in Canada in terms of production, has been producing in northwestern Quebec for over 10 years and operated by Agnico Eagle, my former employer, and again, one of the top gold companies in the world by market cap and production. We have a royalty on Côté in Northern Ontario, which is just starting production this month, will be Canada's second biggest producing gold mine. And IAMGOLD has been around for well over 20 years, well capitalized, very good operating history within Quebec and Ontario. And so that is, again, another generational asset. And finally, among those 3 large-scale operations that we're talking about, we have a royalty on Ren, which is the underground extension of Goldstrike, which is Barrick and Newmont's biggest producer and the biggest producer in the U.S. And that underground extension, we have an exclusive royalty on. It has an initial resource of 2 million ounces with over 7 gram a ton material versus what they're mining in the open pit, which is around 1 gram a ton. So as you can imagine, Barrick and Newmont are well capitalized, already have significant operating infrastructure there, are likely to prioritize that into the mine plan in very short order. And they certainly have the capacity financially and the operating pedigree to do that. So we have some very high quality assets within the portfolio that represent immediate cash flow. And as a result, when you look at our cash flow profile right through the end of the decade, we're looking at about 60% compounded annual growth from that portfolio of operations and development stage projects.
How does the company balance growth with providing the dividends to and returns to shareholders?
It's an excellent question, and we are still a startup. And what's remarkable about our story is 3 years after starting up, when we IPO'd in March of 2021, we're already in a position to actually deliver positive free cash flow this year for the first time. So we've spent a few years investing in the business, building out the portfolio, but we're tipping into free cash flow territory. And that means that we can look at ways to return capital to shareholders over time. The good thing about our business and about the royalty model generally is how scalable it is. We have a very small G&A footprint. There's not a lot of costs associated with running our business. And we've run a lot of costs out of our business since we merged with 3 other companies over the course of 2021. We eliminated a lot of G&A expenditures we inherited in those companies. And then just in the last year, we brought our G&A costs down 50% through our post-merger efforts. And as a result, our cost structure is quite stable now. Our revenue is growing quite dramatically. This year alone, we're seeing a doubling in our revenue. That means every incremental dollar of revenue growth falls right to the bottom line because our cost structure is quite stable. And in fact, with the 8 employees that we have, we could run a business 10 times the size of what we have today without actually having to add to our human footprint. So that means that revenue growth will translate into more free cash flow and the ability to return capital to shareholders in various forms.
Wow, that's really amazing. So did you just say you have 8 employees?
Full-time equivalent. Actually, we share some employees with some of Amir Adnani's uranium companies. And, so we have a back office on the accounting and administrative side that's shared among multiple companies, and that helps keep our costs low. We share an office space with 4 other companies as well. Again, that helps keep our rent costs extremely low. And a lot of us operate virtually. Our head of corporate development, for example, is based out of Toronto because that has an important ecosystem from a mining perspective. And we want our corporate development person there, but he works out of his house. And quite often I work out of my home. This is my home office that you see here. I don't actually have a permanent office in the shared space we have with Amir's companies because I don't need one. I need a meeting space from time to time. And so I just book a meeting room. I don't need a corner office. So we created this company during COVID. We did it virtually. We did an IPO virtually. And we've decided that model actually works exceedingly well because we want to have our people spread out across various geographies to make sure we have access to opportunities, but also it keeps our costs very low.
Well, I'd say it's important to point out that the pandemic definitely shaped our world for better or worse. But for shareholders and investors that are looking at gold royalty, I think it's really good to highlight these things because it's obviously in their best interest. And so I'm just going to swing things in a little bit of a different direction and talk about sustainability and corporate responsibility, because ESG is a huge thing for us. We see the big tab of it on your website. We've looked all through it. And so how does the company approach environmental stewardship and social governance?
I should start by saying that, day to day, there's nothing we really can do because we're not the operators of these assets. We have to rely on the pedigree and the responsibility of our operating partners to ensure that day to day they run safe and environmentally responsible operations. So a lot of our work is actually done during the due diligence phase to ensure that we're entering into partnerships with operators that are responsible, that have a track record of operating in a safe and environmentally responsible way. And sometimes, and there's an example of this in our most recent acquisition of a royalty on the Borborema project in Brazil, we actually provide incentives to the operators, initiate more social engagement with communities, environmental responsible initiatives. And so a portion of the investment we've made in that royalty, for example, is contingent on new social programs being introduced with local communities. To the extent we can influence, we do so really at the outset when we make that investment through our due diligence efforts and then providing incentives to the operators that we provide project financing to in order to invest in environmentally responsible initiatives.
Is there a certain guideline that you follow?
There are certain principles and laws and regulations that we provide a framework within the Canadian mining community that we use to leverage as we're looking at international opportunities. So it does provide I guess a baseline when we're looking at operations to ensure that's at least operating to Canadian principles and policies. And that's a great thing about the mining industry in Canada. It's the one industry where we export talent. I can't think of any other industry where we export talent to the rest of the world, and we're seen as leaders as an industry. Jurisdictions, and that's certainly not true of any other industry that we have within Canada.
So, David, I guess you've seen a lot of change as it is attitude towards ESG. And what we've found, we call it changing the narrative, because a lot of investors we talk to are nervous about it at first until they start to realize how critical it is.
The other thing to really look, when you're looking at ESG in the mining industry, is look at the downstream effect that mining has on our economy. If we hope to decarbonize to the extent that we want to as a society, we need metals to do that. We need electrical vehicles, and that's extremely metal intensive, particularly for copper and nickel and lithium and all the battery metals that we can imagine. We need a successful and vibrant mining industry globally in order to effect the kind of carbon neutralization that we're looking for as a society.
And I'm going to switch gears just a little bit because it was something I wanted to ask you earlier about the structure. And I've been noticing, of course, as a stock trader, that the stock's been doing pretty good lately. And I've obviously gold's had an effect on it. But can you tell us, what's the market look like for a royalty company to go out and find a new deal?
Well, it's been well over a dozen years since the junior sector has had consistent access to capital markets to do exploration. And so they're struggling in order to replace depleting reserves. In fact, reserves in the gold industry are down 40% from their peak in 2012. So coming out of the great financial crisis, there was a lot of access to capital markets for juniors, mid-tier, seniors to do what they do, to explore, develop, and expand existing operations. So we went through a period of massive expansion of exploration budgets post the great financial crisis. And we saw a peaking in reserves in 2012 as a result of that. So there was a lot of exploration success as a result of that access. Since then, frankly, it's been a nuclear winter for the juniors. They've had very selective access to the capital markets, but by and large, the juniors are dying on the vine. And that's why we've seen such a significant and steady deterioration of reserves over that period of time. So really, royalty companies have had to kind of step in and provide more consistent access to capital for the junior explorers, for the developers, and even the operators. What we're seeing increasingly is operators that are actually investing in the ground in new projects and expansions are much more willing to accept streams and royalties in their capital structure in order to affect those expansions and mine builds than they were back, 12 or 13 years ago when there was ready access to equity capital markets. And so that means there's a steady flow of opportunities for us to look at to provide capital. And that's resulted in us growing as quickly as we have.
That would explain why you've been able to do really good deals with the top producers, which I find the portfolio incredible. And I guess that causes a de-risking of the rest of it.
To have some anchor assets that provide a foundational element to our business for decades to come is extremely important. We know we're going to be getting cash flow from the Canadian Malartics and Côtés and Rennes for decades. And that means that we can take on a little bit more development risk in the portfolio and introduce some more optionality on a very cost-effective and high rate of return basis.
I just wanted to ask you if you could share some final thoughts on the precious metals market.
We're in a very interesting point in the gold price cycle, not like anything we've seen since the 1970s, when we last had a major inflation cycle. And what instigated that cycle was the abandonment of the gold standard in the early 1970s by the US government. And we saw a massive increase in money supply. We had an oil embargo, much like we've had recently. We had oil supply disruptions over the last several years, and it resulted in increasing energy prices. So expanding money supply chain disruptions, oil embargoes, a lot of the hallmarks of the 1970s inflation cycle we're experiencing currently. The big difference between that inflation cycle and this one is that back then the debt to GDP globally was only 100%. Today it's remarkably 350%. And so back then you could imagine the central banks could raise interest rates to choke inflation. And they did very effectively. We saw interest rates go to 20% and inflation was 13, 14% back in that last cycle. I was around, I remember that. And this time, I don't see the central banks able to increase interest rates to a level sufficient to choke off inflation, simply because the debt service would be completely unsustainable for the governments. It would bankrupt governments. And so you're likely to see the Federal Reserve pivot well in advance of inflation really actually being tamed. And frankly, the headline inflation numbers we're seeing now, 3-4%, are science fiction. We're not experiencing 3 or 4% inflation. None of us are. We're all in double-digit territory. Many people's mortgage payments are going up 70, 80% on a monthly basis as a result of resets of their mortgages. And we're seeing about half of the mortgages in Canada resetting this year. So there's going to be a reckoning there at the individual level. So that's going to choke off purchasing power at the household level. We're seeing government debt service in the US double in the last 18 months to $1 trillion a year. One out of every $7 in tax revenue generated in the US is going to debt service. That's not sustainable. So the Federal Reserve will pivot well in advance of inflation really being tamed. And as a result, I think you're going to see a sustained rally in the gold price. Gold, if nothing else, is a very accurate barometer of the inflation we're experiencing and the deterioration in our purchasing power of our fiat currencies.
Really incredible. Question though for you then. I was a market maker in the 80s when gold went from 50 to 850. Trading these South African stocks as a market maker. So I do remember it. But what always amazed me is eventually, as gold hit like 600, there were lineups around the Scotia Bank for retail to go in and buy coins. You must have seen that.
Absolutely. And we're seeing a lot of investment demand for gold. Traditionally, gold is jewelry, and there's always been that latent demand within, for example, India, where it's culturally important during wedding season to have physical gold presented in dowries and whatnot. But now we're seeing significant investment demand across the world, in particular China, because China's deregulated individual gold ownership, and that's been a huge source of demand. And also central bank buying has been a huge stimulant for the gold price recently, because central banks, particularly in export-driven economies like China, are dealing with an avalanche of foreign currency proceeds. And what they're doing at the central bank level is diversifying out of the US dollar and US treasuries into gold as quickly as they can, because they recognize that the Federal Reserve has no other choice but to print money to inflate their way out of debt. And so they want to hold on to those US dollars. They'd rather hold on to a currency that can't be printed.
Well, I'm going to have to point out that I wasn't born yet, probably, when all this started.
Well, that's depressing for me.
But I know it's very interesting for me because I'm obviously just learning a lot about this, and Kevin was explaining to me the difference in terms of all the stuff that you were just laying out. So for me, it's just very informational, and obviously we hope that it will help others that are going to be watching Mindstock Talk learn a little bit more as well.
David, a question though on the basis of the 80s when the 70s inflation caused gold in the 80s to do the move it did. Just out of curiosity, and I don't remember this, were there gold royalty companies then, or were they mainly just the miners?
No, that's a fairly recent innovation in the mining sector. I mean, there were royalty companies in the oil and gas space for a very long period of time. And I would have to credit the pioneers in the royalty space, which are Seymour Schulich and Pierre Lassonde, who founded Franco-Nevada back in the 1980s with a royalty on Goldstrike, which is actually an asset we have a royalty on in the underground extension, ironically. So we have the same foundational asset, which I think portends a lot of growth for us down the road as it did for Franco-Nevada. But Seymour came out of the oil and gas space and he said to Pierre, why aren't we doing this in the mining space? And Pierre said, I don't know. I don't know why we're not doing the mining space. And they came upon the Goldstrike royalty in an ad in a newspaper in Nevada. I think it was a Reno newspaper, and they bought the royalty for next to nothing, which turned into a multi-$100 million return for Franco-Nevada. And so that really was what created the foundation for the royalty business. And since then, there's been a proliferation of royalty companies come into the space, recognizing the need for capital in the sector that unfortunately the equity capital markets aren't providing to the sector right now. So we're filling a need. But I do think there's scope for consolidation. There's probably a few too many royalty companies now. And I think creating critical mass is really important in our business to drive down our cost of capital.
Seeking the inside track on gold royalty? Look no further than mindstalkers.com. Our cutting-edge search tool is not only designed to reveal hidden gems, but also provides real-time stock updates. Visit for the insights and stay for the gains. Seize the opportunity and explore the magic at mindstalkers.com. Uncover new investment possibilities today. Don't forget to like, subscribe, and share this video. Let's get the word out there.